Now then, welcome back to Dividend Growth UK. I'm David. In this video, I'll be covering all the received dividends into my SIPP from the month of February. So February brought in £535 in dividend income. That's money I can't touch until I'm 57, but it's building my retirement income stream. 8 dividend payments across the month, including some US and Canadian stocks. Now let me break them all down for you. So a quick reminder, my SIPP is different from my ISA. My ISA is money I can access anytime, and I'm building that for early retirement. The SIPP is locked until I'm 57. That's 15 years away for me. Because of that longer time horizon, my SIPP strategy is different. Less focus on immediate yield, more focus on dividend growth. I'm looking for quality companies that will grow their dividends over the next 15 years. And I get myself tax relief on contributions. I claim back the higher rate relief from HMRC, which boosts my returns. I also hold US and Canadian stocks in my SIPP to avoid withholding tax. If I held them in my ISA, I'd lose between 15 and 30% to foreign tax. In a SIPP, there's no withholding tax on US dividends. So £535 in February. Now let me walk you through each one of them. First payment was QYLD on the 9th of February, £8.14. QYLD is a US covered call ETF, tracks the Nasdaq 100 and writes covered calls for income. This yields around 12% and pays monthly in US dollars. This is a smaller holding for me, just a bit of extra monthly income into the SIPP. February the 11th brought AGNC at £55.75. Now AGNC is a US mortgage REIT, invests in residential mortgage-backed securities. High yield, around 12-13%, pays monthly and in US dollars. This is one of my biggest SIPP holdings because of that monthly income stream. It's volatile on price, but the dividends have been solid. 16th. Now this brought me 2 payments totaling £17.84. First one, Realty Income, £12.97. Realty Income, the monthly dividend company. It's a US REIT, owns commercial real estate, pays monthly and yields around 5%. One of the most reliable dividend pays in the US market. Perfect for a SIPP. Second up was Pizza Royalty from Canada at £4.87. This is a Canadian royalty trust, collects royalties from the pizza restaurants across Canada. It yields between 6 and 7%, pays monthly in Canadian dollars. Small holding, but adds diversification and monthly income. Murray International on the 17th, £34.11. Murray International is a global equity income trust, actively managed, invests worldwide for income, yields between 4 and 5%, and it pays semi-annually. Quality trust with a long dividend history gives me global diversification beyond just the US and Canada. The 20th brought in my biggest SIPP payment of the month, Aberdeen Asian Income Fund at £210.64. Now this is an Asian equity income fund. It invests across Asia Pacific for dividend income and it yields between 6 and 7%. Good income diversifies me into the Asian markets. I like having some geographical diversification in my SIPP. Most of my ISA is UK heavy, so the SIPP gives me exposure to other regions. This fund pays quarterly. February was one of those quarters. February the 27th brought in 2 payments totaling £209.02. The first was Royal London Sterling Bond at £21.12. This is a bond fund, provides some diversification away from pure equities. Yields around 5%, low risk, steady income, acts as a bit of a ballast in the portfolio and pays quarterly. Next up was Greencoat UK Wind, which paid me £187.90. Greencoat is a renewable energy infrastructure fund. It owns wind farms across the UK. This is the same holding I have in my ISA. It's been tough, down 35% on capital, but the dividend has stayed solid. In my SIPP, I'm more comfortable holding it long term. 15-year time horizon means I can ride out capital volatility. Yields around 7%, pays quarterly. Infrastructure assets like this fit the SIPP well, long-term inflation-linked income. So that's February, £535.50 in the SIPP dividend income. 8 payments in total, so what am I doing with the money? Every penny goes back in. I'm in full accumulation mode in the SIPP. 15 years of compounding ahead of me before I can even touch this money. By the time I'm 57, this portfolio should be throwing off some serious dividend income. So just a quick reminder regarding the SIPP versus ISA strategy. ISA, higher yield focus, UK heavy, shorter time horizon. Building income I can use as fast as possible. The SIPP, lower yield, more growth orientated, US and Canada holdings, plus it's a 15-year time horizon. Both are dividend focused, but the time horizons and the tax considerations drive different strategies. If you're following along, subscribe for weekly updates. In the next video, I will be back with more portfolio content. Thanks for watching, and I'll see you in the next one. Bye bye now.